Welcome back to EDS, and in this video I'm going to show you how to trade using statistical analysis. We're not going to use charts, we're going to use statistical analysis and volatility. So the first thing you want to do is pull up your brokerage platform and you want to get up a list of things that you can trade. This is just a standard default watch list, and all you want to do is just open any equities underlying, just pick any at random. Go over to where you can see a list of expiration dates for that underlying, and specifically we are writing options contracts. We're going to be using options when we're writing the options contracts. So pull up a list of expiration dates for that underlying, and the purpose of this step is to lock in on an expiration date that we're going to use. All equities have the same expiration dates, that's why it doesn't matter what you pick, but the one that we want to pick needs to be between 30 and 60 days out in time. It also needs to be a monthly expiration date, not a weekly or a quarterly. The orange W signifies that it's a weekly, so we want to avoid that. So the only one that actually fits that criteria right now is February 21st with 37 days left on the contract. So we're going to take this information, 37 days, come over to our watch list, and then we're going to filter out any and all underlyings that have an earnings event over the next 37 days. And the reason for this is because earnings, or leading up to an earnings announcement, we get an increase in volatility, and because we're going to be writing the options contracts, that basically means we're going to be short the contracts. Now anytime you're short anything, it means you're trying to sell high and buy back lower at a later date. And another thing to know is when volatility increases, option prices increase. So if we're in a position and we get close to expiration or close to an earnings announcement, volatility will increase, and that's going to increase options prices, and that's going to be bad for our P&L. So that's why we want to avoid earnings. And then we also want to filter out anything with a low liquidity level. This is simply because we're only interested in trading liquid markets. The more liquid the market is, the tighter the bid-ask spread is, and the bid-ask spread is what you pay every time you get in and out of a position. So the tighter the spread, the less you pay, the more profit you keep. Now, I personally like to order the watch list from high to low IV rank. This is a matter of personal preference, but just keep in mind that you want to be looking at underlyings with an IV rank of at least 30. So if you just mark that out on the chart here, on the watch list here, so GDXJ with an IV rank of 31. So we only want to be looking at things from GDXJ upwards. Okay, we don't want to go below 30. Generally speaking, anything over 50 is very high, but over 30 is also high as well. So what we're going to do is we're just going to start at the top of the list, and we want to keep in mind what's already in our portfolio. Make sure that you are nice and diverse. Don't be too heavy in any one sector or underlying or anything like that. Use common sense and you'll be fine. So what we're going to do is we've got GLD, we've got the British pound futures at the top here. This is a futures underlying. We're not going to go over futures. The last couple of videos went over futures and how it's capital efficient and how you can use it in your portfolio, but we're not going to go over that today. So we've got GLD trading at just over $247. We've got XLU trading at just over 77. Both have very, very nice and high IV ranks. So in fact, let's actually go with XLU. In fact, let's go with GLD. Why not? It has a high IV rank of 57.1. It has an absolute IV level of 15.4%, which is very similar to XLU. They are both ETFs, and I think it would go well in our portfolio. So what we're going to do is we're going to go over to the expiration dates for GLD, and as you'll notice for GLD, it's more liquid, so we have quarterlies as well, or it's just a bigger underline. There's just more demand for quarterlies and things like that. There's a lot more expiration dates here. So again, none of this matters. Remember, we already picked the expiration date that we're going to go with, 37 days out, February 21st. So we're going to open the options chain up for GLD, and what we're going to do now is simply sell one call and one put. But before we do that, let me explain what's happening here. So on the left we've got calls, on the right we've got puts. This bar in the middle here, or this category in the middle, is our strikes, going all down the middle, and we have a orange horizontal bar going across the middle. That shows us where the price of GLD currently is with respect to the strikes. We've got this orange vertical bar that shows us what the expected move is of GLD over the next 37 days, and then we have these dotted blue lines that show us where our standard deviation levels are, and then we've got delta here as well on either side, delta for the call side, delta for the put side. So if you've noticed, we've not even looked at a single chart yet. We do not trade based off of charts. This is purely statistical analysis and volatility. So what we want to do is, like we mentioned, sell one call and one put. So where do we sell it and how do we sell it? So if you remember from before, earlier in the video, we mentioned that we're going to be writing these contracts. So when we're writing these contracts or selling these contracts, those terms are interchangeable. You can also say short the contracts. It's all the same thing. What you want is for price to stay away from wherever that contract is. So let's say if you were to write a contract at the 236 strike, you want price to stay away from that. You want price to stay as far away from it as possible. And if you are buying the contracts, you want price to breach that contract, and you want price you basically want the contract to then be in the money. We want the contracts to stay out of the money. If you're buying the contracts, you want the contracts to be in the money. So what we're going to do is we want to craft a position that's going to give us a high probability of success. Now we're going to use three things to get that. We're going to use the expected move, we're going to use standard deviation, and we're also going to use delta. So all three of these things will typically line up for all underlying. It doesn't really matter what it is. Everything will pretty much line up every time. So the first thing that we're going to do is we're going to be outside of the expected move. Okay. Now, the further outside the expected move we go, the higher our probabilities of success, but also the lower or the less premium that we collect. So what we want to do is find a happy medium, and that's going to be around the one standard deviation level. And I've personally liked to be in and around the 15 to 20 delta mark. So we've got a 17 delta here on the call side. So if we just sell the 17 delta contract, which lines up with the 260 strike, we can do the same thing on the put side, 17 delta. We can sell that contract, which is at the 238 strike. What you'll notice is these contracts are now sitting outside of the expected move. We are in and around the one standard deviation level, and we're in between 15 and 20 deltas. Now, it won't always be exactly perfect one-to-one on either side. As you can see here, a 17 delta is slightly closer to the expected move on the put side than it is on the call side, and that's absolutely fine. It's normal. It's called skew. We're not going to go into too much detail about what skew is, but basically, yeah, you can see what it is here. It's just one side is slightly different to the other. So this is our position. We've crafted our position here. So let's look at the numbers. What does this mean? So price is currently at 247.51, and our strikes are at 238 and 260. So we've basically created a range for ourselves. So what this means is we want price to stay within this range. Okay, and if price is within this range at expiration, which is 37 days away, then we will keep 100% of the premium that we collect up front. And what is the premium that we collect up front? It's this number down here, 2.07. Now you multiply this number out by the contract multiplier, which is 100 for all equities. So our max profit would be $207. So $207 is the premium that we collect up front. It gets added to our cash balance automatically by our broker as soon as this order gets filled. Now, provided that price stays within this range in 37 days time, we keep all $207, just like an insurance company does. When they sell you insurance, you pay the premium. If you don't claim on the insurance, they keep the premium, and that's it. This is the exact same business model that we're running here. Now, what's the likelihood of that happening? Well, if we look in the bottom left corner, we have our POP of 72%. POP is probability of profit. So what that means is we have a 72% chance of making at least 1 penny on this position at the point of expiration. So already we have a very high probability of success. Now, what if we don't want to wait all the way to expiration? What if we want to get out at, say, 50% of max profit? We want to take profit out around about the $100 mark. Well, we have a P50 here of 88, between 86 and 88%. It's hovering around. So we're looking at probabilities of success between 72 and 88%, which is extremely high. And when you trade this way, these probabilities are normal, but in general, it's very, very high. Anything over 50% probability of profit is considered a high probability trade. So when you're looking at probabilities between 72 and 86% or 88% even, that's very, very high probabilities of success. Now, so we know what our probabilities of success are. We know what our max profit is. There's also this number here, theta. So assuming all other Greeks stay the same, we will get $7.75 in daily theta decay. So that means we're going to be making $7.75 every single day on this position. That's as of right now. Assuming all else stays equal, this number will get more and more aggressive as we get closer to expiration. Gamma risk also increases as we get close to expiration, but that's beyond the scope of this video. Just know that theta increases as we get close to expiration. So as we move through time, you will make more money provided all else stays equal. Now, we will collect $207 up front, and our broker is going to require just under $5,000 in buying power to open this position. Now, you might be thinking, everything sounded all well and good until we needed $5,000 to open this position. Now, I've got good news for you. If you do have a smaller portfolio and you can't allocate $5,000 to each position, then what you can do is use some of this premium here, this $2.07, to buy some contracts a little bit further out of the money. So let's say on the call side, we buy the 265 strike contract, which is going to cost us 59 cents. So as you can see, our premium has gone down, but we now have this contract. And we can do the same thing on the put side. We can go $5 wide. So 1, 2, 3, 4, $5 wide at the 233 strike. We can pay 48 cents and buy the 233 strike contract. As you can see, our premium has been reduced. However, if you have a look here, our buying power requirement has been significantly reduced as well. It's now going to require $399. And the reason why is because our loss is now defined. And it's defined by the spread in between our short and long contracts minus the premium that we collect, multiplied out by the contract multiplier, and we get this max loss number here. And our broker knows what the max loss is, and so it only needs to hold that much in buying power to open this position, which is $399. Now, what you'll notice is that our pop has reduced slightly and our P50 has reduced slightly. It's still 68 and 81%, which is very, very high. However, what you will notice is now our max profit is 102 and our buying power requirement is 399. So we've got a much higher return on capital. We're looking at over 25% here in 37 days time. Now, what you can do is be a little bit more aggressive, because when you have a defined risk position, you can be more aggressive. So let's just go all the way to, say, a 26 delta, right? Or let's go to it's going to be a little bit difficult because the strike selection isn't equal. It's not 1-to-1 on either side. If you have a look here, it only goes up in $1 increments up to 260, then $5 there on out. But on the put side, we've got $1 for quite a while. So what we're going to do is we're not going to go $5 wide. We're going to go, say, we're going to go to, say, $4 wide. Okay, so we're going to move our short strike to the 26 delta contract, which is at 256, which is just on the edge of the expected move, and we're going to be $4 away on our long contract, which is going to cover our short. And we're going to do the same thing on the put side. So we're going to go to the 20, well, we can either go to the 24 or the 27. Let's just go to the 24 because we're already inside the expected move a little bit. And then we're going to go $4 wide on our long contract. 1, 2, 3, 4. That's going to take us to the 237 strike. And what you'll notice now is our probabilities of success have dropped because we are more aggressive. Our delta has increased. So our pop is 55%, our P50 is 69%, which is still very high. We collect $1.45 in premium, so $145, and our buying power requirement is $255. So what you'll notice now is that we've got a much higher return on capital here. So we've got a a max profit of 145 and a buying power requirement of 255. So we're looking at, let me just run the maths very quickly. So 145 divided by 255 is going to give us 56.8% return on capital. So nearly 57% basically. Now that is how you find and manipulate positions to fit inside your portfolio using statistical analysis and volatility. We're not using any charts. Charts, by all means, if you use charts, great. But at EDS, we don't trade based on charts. We trade based on deltas, statistical analysis, and volatility. And that is how you do it. And you want to keep doing this over and over again with lots of different diverse underlyings. Build up a portfolio that's going to pay you daily theta decay over time. And you want to have as many occurrences as you can. Now the only other thing that you do need to keep in mind is how much buying power you are allocating to your positions. So we've created a free position sizing template for everybody to use. The link is in the description. When you click that button, it will take you to this spreadsheet, and the way it works is you enter in the size of your portfolio at the top, and then below you simply enter in whatever the current VIX level is, and everything will then be automatically calculated for you. So it will tell you the maximum amount of buying power to allocate to a single defined risk, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general. And as long as you are following this template, you will be absolutely fine over the long run. And if you want to learn more detail about what we do and how we do it, again, link will be in the description. This time click on EDS Premium, get yourself signed up. Inside you will have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments, etc. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It is a private community, so you can speak with other like-minded individuals and with myself directly if you get stuck. And there's a 100% money back guarantee. So after 6 months, once you've gone through the course and followed some of our trades, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk free, and right now it's £1 a month to join. It's super cheap because we've just launched. The price will be increasing. However, once you're in, the price is locked in for life, so you are rewarded for getting in early. And the aim of EDS Premium is to teach you the skill, teach you how to write options contracts, teach you how to manage risk, teach you how to make adjustments profitably and consistently. And we aim to give you that skill, so it's something that no one can take away from you, and it's something that you have for the rest of your life. And we want to get you to that point within 6 to 12 months. You are always welcome to stay and be a part of the community, but 6 to 12 months and you should be good to go. So with that being said, I will see you guys on the inside.